Okay guys, very good morning. Welcome to the briefing for Thursday, the 25th of August. I'm just kind of going through my normal routine of going through the news and stuff from overnight. Very quiet, almost getting even more quiet than ever now. Looking at some of the stats from yesterday, the trading range in the Dow so far this week has been 1%, just over a third of the 2.6% average full weekly trading range of the first 33 weeks of 2016. So certainly things getting into real summer conditions, and predominantly based upon the fact that the market is waiting for a very key event of that being, of course, Jackson Hole Symposium, where Janet Yellen will deliver her latest kind of insight on the economy and also monetary policy, which will be tomorrow afternoon. Just looking though at the moment, got the DAX here, top left, just touching on fresh lows actually as we speak, under a bit of downside pressure since the cash equity open around half an hour ago, but just testing around this 10,522 level now, although it's chopped through there back on the 22nd, has not really sustained any downward move since that point, and that coinciding with the high that was seen around mid to late April. Likewise in the SPOOs, we've been fairly tight ranges here. We haven't yet really tested 2200 on the upside, but as I've said before, dependent on what Yellen says, that really can't be ruled out, but we're starting to pull a little bit away from that. Downside of the more recent range seen since, well, the 4th of August, if you remember, that was when the Bank of England over-delivered. That was kind of a supportive factor as well for global equities, the fact that they're continuing to support the market. The SPOOs the next day, that was when we punched up to fresh all-time highs, and ever since then we've been really confined to a range defined by around 66 to 91.5, which of course is the all-time high at the moment. Likewise elsewhere, a quick look at crude. We obviously had the move lower yesterday after we saw the Department of Energy's crude oil inventories. We've kind of steadied then throughout the rest of the US session, and it's pretty much gone sideways ever since then. And thus far this morning, pivot at 47, so that psychological level having held kind of late Asian trade as Europe started to early birds getting in. Quick test on that, but it's held thus far, so pivot a fairly decent level thus far in oil, so something to keep an eye on that as well. A couple of graphics though I have seen this morning that are probably worth looking at, that kind of encapsulate how the market has gone into very subdued mode ahead of Yellen. Yields in terms of the US have fluctuated by 15 basis points in August this month. That's this candle you can see, or this bar that you can see on the furthest right. You've got to go back a hell of a long way before we've seen this type of lack of movement in the yield. A lot of the press reading this morning is all talking about how Fed speak basically is losing its power. The fact that Treasury yields are seeing the least amount of fluctuation in a long period of time. In addition to this one, which is the 3-month options on 10-year swaps, essentially a kind of protection, I guess, against volatility, and that too, as well, you can see this downward trend we've had since June, July, August. So it's almost as if the more hawkish the Fed becomes, the less really the market is buying it, and this can be slightly worrying, I guess, twofold. I mean, one thing is that certainly on this chart you can see here, this is stocks volatility gauges and near the year's low at the moment. So this is the S&P volatility index at the top in white, for the Euro stocks in blue, and for the Nikkei at the bottom. And we're at yearly lows in terms of built-in stock volatility measures. Now, I find that quite worrying, and the fact really twofold. One, the Fed are telling you they're going to hike rates, and yet the market is now not priced for that to happen. If then the Fed deliver on their promise, and we do see a September rate hike, For one, Piers' call yesterday on CNBC, he was pointing out the various reasons why that would be a good idea, even though he sees it as a low likelihood. But the fact is, they're telling you they're going to do it. So is it a bit foolhardy to just think that no, they're not, when the communication is so strong on the hawkish bias? The other flip side of that, of course, is that if the market is not prepared for it, i.e. not priced, then it's going to cause a huge amount of volatility. And is that also enough to kind of lock the Fed's hands, if you like, or shackle them, because the fact that they've not been able to prepare the market sufficiently? One interesting comment out of a fairly big hitter in the bond space, Richard Clarida of PIMCO, he's been talking about there's a failure to communicate. Now, this is coming from a fund manager who manages $1.51 trillion, saying that the chair, that's Fed Chair Yellen, has not come forward to convey where she wants to take the committee. So as a result, we have mixed messages. That's why investors are looking for Yellen to bridge the gap. Now, Yellen has taken on a whole new realm of importance here, because either she certainly keeps the recent script of hawkish undertones from Fed members and says something similar, which I think it would be foolish to really discount September, and maybe the market might start to lift back slightly, a bit of dollar strength, maybe yields might pick up if she does stick to the script. Or does she kind of look at the current state of play, not only from an economic data standpoint, there's some of the worst retail sales, low growth in the States, still inflation remaining on the low side, in addition to the market's mispricing, and does she then essentially communicate that September is really off the table, and they're going to alter the dot plot, and although they might hike in 2016, it's certainly not going to be in September or anytime soon. So again, the market, in terms of today's conditions, it would not be surprising to see a fairly quiet session. These institutional type players, and in terms of certainly these hedge funds and big bond funds, are certainly not going to be trading in any sort of size ahead of such a big event, where essentially she's going to tell you what the path is going to be going forward into late September, when we have that rate decision on the 21st of September. A quick look though at what could be one of the more market moving events of the day, especially for European assets. So if you're looking at the DAX, Euro Stoxx Bund and the Euro currency, we do have the release of German IFO coming out in around 20 minutes time. Quick recap, this is probably one of the most important data points that comes out of Europe and Germany on a monthly basis. It's a measurement, as you can see here, of a survey of 7,000 firms in manufacturing, construction, wholesaling and retail industry. Essentially, a business climate balance is constructed as a difference between the percentage share of executives that are optimistic and a share that are pessimistic. So again, this is a soft piece of data, forward-looking, and it's important because the market looks at this as a gauge to price expectation for the future performance of the Eurozone economy, as Germany being the engine room, so to speak. So this is a very important figure. Look out for that at 9 o'clock. The last figure at 108.3 was above expectations of 107.5. So manufacturers and wholesalers, in terms of their mood, deteriorated, while constructors and retailers' sentiment had improved the last time out. So looking at July, we haven't really seen any great knock-on effect from Brexit. So keep an eye on that figure. That's going to be probably the bigger event of the morning, because looking at the calendar, other than that, it's more of a US focus. We've got the durable goods orders reports, the weekly jobless claims, and the service PMI number all coming out this afternoon. So 1:30 and then 2:45 are the times you need to be at your desk. You can see marked here the Jackson Hole Symposium. That does actually start today, but Yellen does not speak until tomorrow afternoon. Okay guys, as I said, it's pretty quiet though overall in terms of news. So I'm going to leave you to get on with it. 15 minutes until IFO. I would say you want to be identifying solid technical levels today, because most likelihood is the market's going to be potentially confined to range type trading as the market sits on its hands and awaits the big main event coming on Friday. Okay, thanks, and enjoy your session.